What are your preferences in terms of equities now? Is it still just within the DM space? What do you like?
So we still like US, Europe, and a little bit of Japan as well. So we do think all of this do have a pretty strong fundamental support. Clearly, Japan today's GDP number not that strong, but we do think as the wage growth start to filter through into the economy, there's still more momentum there.
There's a big earnings print next week out of NVIDIA, and a lot of people are looking at that as, I guess, lots of makes or break moments for this market. But is there a number ugly enough there that could make you change your call? Or is there a broader story now that supports this U.S. equity market that NVIDIA might not matter as much as it did in the past?
I think the fundamental point really is earnings growth need to be strong enough to justify the high valuations. I don't think it's just stock specific, but just the broader market. We just need to see the earnings coming through. And that's what we have seen mostly in the Q1 earnings season. That's why we still remain positive.
Okay, so you're still going long on these equities. What about when it comes to fixed income? What sort of exposure should investors have now?
So when we look at fixed income now, we still have a preference for U.S. high yield, given that we think recession risk in the U.S. is relatively low at the moment. Yes, credit spreads at historical heights, so we're not really seeing much room for capital appreciation, but that overall carry is still attractive for us.
Treasuries, or have you just answered the question that it's really high yield where the best value is?
Yeah, it's just Treasury overall duration view, we're relatively neutral right now. Yes, we had a good inflation print, but we still think the uncertainty in terms of the timing of how fast it comes down still there, and growth seems to be a bit more resilient than what people expected. So more neutral there on duration.
In terms of other asset classes, I mean, what else are you looking at in terms of, obviously, we talked about 60-40 not quite working. Are correlations still going to be quite broken for the rest of the year?
Yeah, I think recently, if you look at what's been happening, still seems to be positively correlated. The stocks and bonds are clearly a challenge for us multi-asset investors. But we do think as inflation comes down later with that loosening of labor market conditions, we could see that tilt back to negative territory.
What are the questions you're getting now in China? I want to ask you about that, because the rally is obviously still taking place, I believe. Yeah. But now you have the U.S., of course, as an alternative to your point. What queries are you guys fielding from clients these days?
Yeah, I think it's more a question about the sustainability of the rally and how much of that is fundamental driven. There were some questions about whether it was just a rotation from other regions in Asia into China. But we're seeing more positive policy news, which we think could be a catalyst